All right. Good morning, good afternoon, everybody, wherever you're calling in from. Uh, my name is Ryan Polimeni. We are going to go through the new 2026 TSP and tax changes. There's been quite a few of them, and there's really some significant things that we want to make sure everybody pays attention to this year. There was a lot in 2025, and if you joined us on some of our webinars that we did last year, we talked a lot about the changes, and we've had the privilege of helping a lot of you kind of walk through piece by piece with those changes, where to really take advantage of it. We are in such an exciting tax time. I know it's really weird to hear. No one likes paying taxes, and we're in that time of the year where we have to do our taxes. But in the world that I live in, as someone who has been in the tax profession and helped a lot of people with tax planning and advising for over 15 years now, these are really important years for all of you. It doesn't matter where you are in your career. I know some of you are probably newer to the Fed system. Some of you have been in the Fed system for a very long time. You're getting ready to retire. It is equally as important for every single person to pay attention to these changes as we go through them, because they all apply to you. Some will apply to you as you're a little bit older, but a lot of the changes applied to everybody listening in right now. And what my job is to deliver the information in a way that is simple for everybody to understand, and that you know how to take advantage of it. Because the biggest thing is being able to take action on what you learned today, because these are significant. And like I said, some of these that I'm going to go through today, they only have a 4-year window to them. So for those of you that are getting ready to retire or in retirement age, there's some things that I'm going to talk about today that you can take advantage of. That's a window of opportunity that you may never get again. And I'm going to give you some of the inside track to what these are and how you can take advantage of them today. Okay, so once again, thanks everybody for being on. It was well over 2,000 people that were going to be on this webinar today. So appreciate all of you from all over the country logging in. And once again, my name is Ryan Polimeni. This is MyFed University. For those of you that have not attended a MyFed University webinar in the past, welcome. MyFed University is one of the largest federal education companies on the planet, training and teaching well over hundreds of thousands of federal employees every single year. In the last 5 years, they have trained pretty much pushing 750,000 federal employees. So really a great opportunity for me to be able to help and contribute here. So again, my name is Ryan Polimeni. I have been working with federal employees now for over a decade, and this is the information that I feel is pretty much most important as you start your year off. Because look, we all are going to start this year fresh. There's a lot of changes, and you have the entire year to take advantage of some of these changes. But I want to give a couple quick disclaimers before I dive into this. I am a network representative of MyFed University. I'm vetted through their system to be able to give these workshops and be able to teach this. And then I've had the privilege now of teaching these workshops all over the country, from Maine all the way to California and everything in between. So I love doing this. I've been able to help a lot of people, but really what I want to make sure everybody understands is I'm going to talk a lot about taxes today and the changes within the TSP system, because most of the changes are pertaining to taxes, and they are so important for all of you to pay attention to. Because a lot of you can take advantage of them, okay? And I really want to make sure everybody knows how to do that, because it helps you not just in the short term, but into retirement years, okay? There's a lot of misconceptions out there right now, so you're going to hear me talk a lot about those, but the information that I give today is general information, okay? And things change all the time, so make sure you're always looking at the most up-to-date information that's out there in the Fed system, because things do change quite often. But I'm not a CPA. I have two that work for me. So if you need tax advice, you'll be able to get it there. You're going to hear me talk about estate planning and how the new tax laws and TSP work within estate planning, because there are rules that most federal employees do not know about that really could help or hurt you in retirement years when it comes to estate planning as well. So today's general information. So once again, don't take what I say, go out and do it without talking to somebody. Now, I know a lot of you are going to have questions coming into this workshop, and you will probably leave with more questions as we finish up with this workshop. So here's the thing: because we have 2,000 people on this webinar, I cannot take personal questions, but you will have the ability to ask questions and get them answered. Okay, that is part of what MyFed University does, is they make sure that any questions you have, you have the opportunity to get your questions, your specific questions, because some of you will have general questions, but the majority of you are going to have specific questions pertaining to your financial life and your financial situation, okay? And a network representative will be able to answer those questions for you. So here's what I ask you to do, and this is important, is write down all the questions you have throughout this workshop today. Because what's going to happen is at the end, you are going to have the ability to put those questions down on paper, and one of us will be able to answer them for you. We will get back to you, we'll answer your specific questions one-on-one. There's no obligation to do it. We just want to make sure we're getting your questions. So I always recommend to everybody, write a book. The more information we have to be able to answer some of your specific questions, the better it is and the more value we can bring, okay? So we've done this in the past, and we had 2,000 people on, and we had 1,700 people write a book to us in questions, and that's fine. We love it. We want to be able to help. So write your questions down. At the very end, we'll help, okay? So MyFed University, again, is one of the largest federal education companies on the planet. They are a government registered entity, which means that they can go and bid on government contracts. They're approved through the federal government to be able to give these workshops and to vet network representatives, which is really important. They host these webinars regularly. There are several different contributors to them that'll do different topics. I know they have several topics lined up for this year, which are going to be very great information to help with everybody. There's up-to-date TSP information, and there's free financial planning tools. So if you have not gone to myfeduniversity.com, highly recommend doing it. Subscribe, there's no cost of doing it. If you subscribe, you get access to a lot of pre-recorded webinars or webinars that were done last year that are super helpful, so you can get a lot of great information, okay? Now here's the agenda for today. The new 2026 tax tables. There's been changes to them that are going to be important for all of you to see and know. We're going to review the taxable incomes and retirement. That's going to be really important because there's changes to the TSP that are going to pertain to that. TSP advantages, changes, traditional and Roth. If you've ever been to one of our webinars before, you know we actually do an hour-long Roth versus traditional webinar. I'm not going to have the full hour to get into it, but I'm going to touch a little bit on both of those because one of the biggest questions that we have been fielding for the last several months is on this new conversion opportunity inside TSP. I know all of you got an email from TSP about the opportunity for Roth conversions. Before you do, please let me go through the ins and outs of that, okay? We have already had to tell people that might not be the right way to do it just because it really would affect them and they didn't know what the rules were, okay? So I'm gonna go into that today because I know it's a big question we have been fielding from so many people, okay? And then I'm gonna talk about Social Security and taxation. So once again, as you kind of see, the theme of this is gonna be the tax changes and the TSP and kind of how everything works in harmony together. What I want everybody to think about is these few pieces to the puzzle that I'm going to talk about today. What you will notice is how every one of them has to work together for your retirement to be successful. You can't do really well in one area and bomb in another one, right? You have to have everything working together. And so today is about how to bring these new changes and everything working in harmony with each other, okay? So here are the new 2026 tax brackets. These changed. They have more space between them than they did last year. So the first advantage is we have more opportunity to make a little bit more money and stay in the same tax bracket. That's always important, right? Is to be able to make money and not go to the next tax bracket. Now, if you're making so much money, you're forced to the next tax bracket. That's not always a bad thing either. But you know, for conversation's sake, we like being able to make money and stay in the lowest tax bracket possible. And I want you to look at these. So on the left, we have if you are a single filer. Okay, now that could be married filing single, doesn't matter, just a single filer. These are the spaces between each bracket. Now, without getting too technical, what you see on your screen here is called the marginal tax brackets. And marginal is the levels that you get to, right? So on the right side of your screen, you have a 10, a 12, 22, 24, 32, 35, all the way to 37. And what happens is, as you continuously keep making money, you go to the next tax bracket. And that's why they're called marginal, because if you are in the 22% tax bracket, you are not paying 22% on your entire income, you may be paying somewhere around 18%. That's called the effective tax rate. And those are two very important things to know, because a lot of the times when we're working with federal employees and we're doing tax planning, one of the things that is very, very overlooked is the difference between the marginal taxes, which is what you see on your screen here, and the effective tax rate, which you actually pay tax on. And if you're doing financial planning and you are not doing tax planning in conjunction with it at that high of a level, you will make mistakes. I have seen it for 15 years straight. It drives me crazy, but you have to make sure that those are built in. Okay, so let me just give you a quick example. A lot of you, if you're married filing jointly, or most of you that are kind of on this call will probably fall in that 22% tax bracket. If you're a single filer, you can make between 50,000, 401, all the way to 105,700. So that's a good range. That's a $55,000 range of money you can make and still stay in the same 22% tax bracket. These are different, right? These brackets change this year, so pay attention as you go into this year. If you're married filing jointly, at the 22% tax bracket, you can make between 100,801 and 211,400. You have a $111,000 income gap between you and your spouse to be able to stay in the 22% tax bracket. That is great. I mean, that went up about $10,000, give or take, from last year. So that's a big jump, and I think it was around 6,000, but that's a big jump. And that gives you the ability to make more money, because here's what else went up that I'm going to talk about. The standard deduction also went up for a single filer and a married couple filing jointly. So what does that mean? That means that as you go down this journey of working at the federal government and you are thinking about Roth, traditional, how much money you're going to put into your TSP, how do I stay in the lowest tax bracket? Maybe these new conversion things are incredibly confusing and you want to know how to maximize that. What you see on your screen is the foundation to making decisions. Okay, we don't throw darts at a dartboard here, right? That's how you make mistakes. We don't want to make mistakes. We want to make decisions that put you in the right direction and maximize your retirement. I want you to kind of think about, like, your job is to maximize every part of your retirement. Now, again, they don't have to all be done at the same time, but knowing where the foundational pieces are play a really big role in that. Okay, so I want you to just take a look at your screen real quick. Just figure out, where do you fall? You know, and how close are you to the next tax bracket? Because what I'm going to talk about as I keep going today is, when you're making decisions, you need to know where you fall in this tax bracket, because you could say, hey, you know what? I'm going to go and I'm going to take $50,000 out of my TSP this year because I want to pay down the debt. No problem. Obviously, it's your money, but does that $50,000 move you from a 12 to a 22% tax bracket? And think about how big of a hit that would be. Maybe you can only move 45,000 out and stay in the same 12%. These are things we're going to want to make sure that you pay attention to. And I'm just giving you some basics because I've seen a lot of mistakes made here. I'm kind of steering around some of those potholes as we go through. Okay, so what's taxable? This is going to be incredibly important for you to know. And if I was you, what I would be doing, if I'm taking notes, this would be one of those things I'd take notes on, because this is confusing for a lot of people. But when I talked about the very beginning, everything working in harmony with each other, I want you to kind of visualize these three buckets of income, because as a federal employee, you are going to have three different buckets of income, right? You're going to have your pension or your annuity from the government. You're going to have and by the way, that's fully taxable unless you have a disability military, but everything else is fully taxable. Okay. You're going to have your TSP distributions or IRAs. Maybe you have another 401k or an old, 403b or whatever. If it's a traditional TSP, traditional 401k or IRA, every single penny that comes out of that bucket of money is taxable at your ordinary income tax bracket. And that's really important, because the distributions you take from there could throw everything else out of whack, right? Social Security. A lot of people do not understand how Social Security is taxed. I'm going to explain it as we go today, but most people don't know how that's taxed. And I got to tell you, one of the biggest mistakes people make is, since they don't know how it's taxed and they don't withhold, they go into retirement and their first year they end up owing a big tax bill because they didn't withhold from Social Security. But what they didn't realize was that the IRS, the TSP distributions that they took were the reasons that their Social Security became a taxable income, right? That's how you have to understand how everything works in harmony together, because the amount of money your pension is, the amount of money your distributions are from TSP could be the thing that bumps your Social Security to a taxable income, right? And so all those are important. The same thing works the opposite way. The amount of your Social Security, the amount of your pension could determine what tax bracket you go into based on how much you take out of TSP. All these things play a very big role. So understand what's taxable and what's not. Now, Roth is not taxable, and that's why a lot of people are incredibly curious about this new Roth conversion thing, which I completely understand. That is not a taxable, but there's some rules to that we're going to talk about. Now, I'm going to kind of give away our secret sauce. So working with federal employees now for 15 years and doing these workshops all over the place, these are things where if you decide, hey, I got some questions, I need some help, and you want to get some reports ran for you, and that's going to tell you things like your pension, your Social Security projections, your TSP projections, those are all things that MyFit University can do. And that's what, and you will get that if you decide to, just have a consultation. We will do that for you. And the reason that we want to make sure you do that is because we want to make sure you know your numbers, right? And when you are planning, I'm kind of giving away our firm secret sauce here a little bit, but when you are planning, these are three buckets. I know you saw the taxable buckets. These are the three bucket strategy that I think you should pay attention to. And there's obviously the three buckets are the income bucket. Do you know exactly to the penny what your income sources are and what your income is going to be? And I'm not talking about just I have an idea of what my pension is going to be. I'm talking about, do you know exactly in 2026 with all the tax changes and TSP changes, do you know exactly what your pension is going to be, what your TSP distribution is going to be, what your Social Security is going to be? And do you know how that falls into the income bucket? Do you know out of, let's say, I'm making up a number, let's say you have $500,000 in your TSP. Do you know to the dollar how much of that 500 grand you're going to need for the purpose of income? And I'm asking that because some people do, some people don't. And I think it's something that it doesn't matter how old you are and how close you are to retirement. These are things that you should be thinking about, okay? Because what it's going to allow you to do is to build a real strategy that's going to allow you to have a healthy retirement. So many people play the guessing game. Well, I have 500,000, I should be enough. Should be, or is it, right? Those are two very different things in retirement, and it's a mistake I see a lot of people make, okay? So make sure before you worry about growth on my money, Roth conversions, all these other things, make sure your income is taken care of, because nothing else matters. I'm not trying to be like, but nothing matters. Of course, we all want growth. We all want to be tax efficient, and those are all things that you can do. But the reality is, if you don't have enough income to cover your bills, are you really worried about those two other things? Probably not so much, right? You want to make sure your bills are covered and everything else becomes that secondary long-term strategy, right? So that middle bucket you see is maybe that the money that you don't want to take a lot of risk with. Maybe you're, a year away from retirement, or you're just going into retirement and you go, look, I worked 30 years to save up this $500,000. I don't want to lose any of it. Okay, well, cool. Then you know that in that middle bucket is where you should be more conservative with your money. And a lot of times what we see a lot of our clients do is that kind of conservative part, they begin doing things like Roth conversions with, because maybe you don't really need that money. It's there for a rainy day. You don't want to lose it, but your income is good. Those kind of Roth conversions and tax strategies begin making a lot more sense at that point. Okay, and then that third bucket over there is that long-term savings bucket. That's the home run bucket, right? That's to say, hey, I got 500 grand. I needed 300,000 of it for the purpose of income, and I'm going to take 50,000 out of the 200 grand I have left, and I'm going to swing for the fences. If it goes away, I'm not going to be happy, but if it goes up to 100 grand, I'm going to be thrilled, right? That's the kind of money that in retirement you don't mind taking risk with, but that money can't affect your lifestyle one way or the other. And I think that if you begin to look at earmarking dollars to perform certain things, you'll start thinking about money management differently. And I got to tell you, when we work with thousands and thousands of federal employees doing tax planning, financial planning, this is what we spend a lot of time on. It's really great to see the light bulb go off when you start thinking about money management a little bit differently. Okay, so again, write this down. This should be a pretty important part of your retirement planning. Start thinking about money, how it moves, because all these things I just talked about coincide with how the tax has changed and how TSP options have changed, right? In order to maximize each one of these buckets, you got to know how to play the rule. You got to know what the rules are and how to play the game. And I'm going to explain that as we go. So let's talk about the advantages of TSP. Number one, the regular contribution limit, meaning how much you can put into your TSP at any age, but really if you're under the age of 50, you can't do a catch up. But the regular contribution limit this year is $24,500. So that means you can put up to that in your TSP, which is a lot. And that's a great opportunity for a lot of people. Now, if you are over the age of 50, you have a catch up. And that catch up allows you to put an additional $8,000 in. So that's up this year as well. Those are two changes. Those allow you to put more money into it. And here's the thing. A lot of people don't know this, but last year, there was a special catch-up supplement that was introduced. Now, if you are between 60 and 63, your catch-up on top of the 8,000, this is not in addition to the 8,000, this is total, is 11,250. So again, did you take advantage of that last year? And if not, this may be the better year for you to do it, right? Because we know now going into this year, when you are planning for your TSP and you're thinking about how much do I want to put in this year, how much can I afford, know what the limits are and what the maximum amount is, and you can start building around there. So if you do this the right way, you could put in $32,500 if you are pretty much under the age of 60 and you're using the catch-up, or if you have that special timeline between 60 and 63, with the extra catch-up, you could be at $35,750. That is a lot of money to be able to put into your TSP. And by the way, to be clear, that money can go into your traditional TSP, or it can go into your Roth TSP, or a combination of the two, but not to exceed those maximum amounts. Okay. Now, obviously, you can get the matching contributions up to 5%, and you can contribute to both traditional and Roth. So as you look at these, the first thing to do is know your numbers, know the limits, know the maximum amounts, and know what your budget allows. Okay. Now, let's talk about the difference between traditional and Roth, because I got to tell you, a lot of you are thinking about this Roth thing because you've got that email and it sparked interest. And so let's break down the differences between the two first, so we have a good understanding of what to expect and how things would move both short-term and long-term with these new changes. Okay, so your traditional TSP is a pre-tax contribution. What does that mean? That means that you get your paycheck, money goes into your TSP, and then you pay taxes. So what does that do? That allows your traditional TSP to grow on a tax deferred basis. Now, really pay attention to that word deferred. What are you doing? You are deferring your tax liabilities and your tax problem to a later date. Now, sometimes that's good while you're working, is helping you lower your tax liabilities today. But for a lot of you, you're going to spend a lot of time unwinding that tax deferral, and I'll explain what I mean shortly. Now, all matching contributions are going to go into this account that you put in, that you are getting matched on, okay? With a caveat, which I'll go through. But for the most part, all your matching contributions go here. Now, on the flip side of that, you have the Roth TSP. And this is a golden nugget, because I think there's a few things that are in TSP that are so important to know and take advantage of. Now, this is like the complete opposite. This is where you get your paycheck, you pay all the taxes, and then you put money into your TSP. And what that allows you to do is to grow your money on a tax-free basis. That includes all the gains and all the interest. So what you put in, what the market goes up, you are paying taxes now instead of paying them later. And some people argue, well, Ryan, when I retire, I'm going to be in a lower tax bracket, so I'm not really too concerned with that. Well, let me give you, now I'm on year 16 working with federal employees, and then I just want to give you a stat that's really important, okay? 64% of our clients that we work with in the federal net, and I'm talking about a pool size of thousands, 64% of our clients are in the same tax bracket when they retire than they were while they were working. Why would that be? Why would that be the case? Well, number one, it would be the case because you have three sources of income. Most people in the private sector do not, right? Most people in the private sector have Social Security and maybe their 401k. So most of the time, sure, they may go, but you have a pension, you have Social Security, and you have a TSP distribution. Those three things typically keep you in the same tax bracket. So if we know that, why would we want to be more in Roth now? Well, because if we know that, and we know that the distributions from the TSP may be one of those contributing factors to never getting to a lower tax bracket, and you put money into the Roth, when you retire and you start taking distributions, that's all tax-free. That could help you. Remember if I go back to the three buckets of what's taxable, what if we could eliminate the TSP being taxable, and that may have been the one thing that made your Social Security a taxable income? You see, remember I told you everything here has to work in harmony with each other. The decisions you make with TSP will greatly affect your taxes, how your Social Security is taxed, how your pension's taxed, and vice versa. Okay, so as you start thinking about these things, this is where you start making these type of decisions. Now, you have such a golden opportunity inside TSP while you're working to take advantage of this Roth, because here's what happens. If you go to XYZ financial company and you say, hey, I would like to open up a Roth IRA, they're gonna say, great, how much would you like to put in? They say, well, you know, in my TSP, I'm over 50, I could put up to 32,500. I like to do that. They're gonna say, sorry, the maximum you can do is 8,600. And you go, well, that's not a lot. I want to be able to put in. You don't have the same opportunity on the outside that you do on the inside, and that's a really important thing for everybody to understand. Um, the other thing too is you can do both, by the way. Most people don't know that either, but you can do both, but just know what the limits are. Oh, and by the way too, if you are contributing to an outside Roth IRA and you make too much money, you could fall into what's called a phase out period. And that phase out period basically says, hey, you make too much money, you can no longer contribute to a Roth IRA. TSP does not have that option, which is great for you. You can make $400,000 or $500,000 a year as a federal employee, and you have no phase out period. That is incredibly important for all of you to know, okay? Because there's a big misconception about that. Now, the last rule that you need to know about this is the Roth must be in place for 5 years to reap the tax benefits. That's the same inside, and it's the same on the outside. Okay, so those are really important things to know about TSP. Now, as we kind of talk about the advantages and how you work this, let's work the numbers. So a lot of people, when we do this, and again, by the way, these numbers change. So I want you to pay attention on your screen because this is a real life example of a federal employee that didn't really understand the Roth piece, and they didn't understand they could get the best of both worlds. So here's an example. This is an employee that came to us, a federal employee, and said, hey, I need some help running my numbers. I don't know if I should do the Roth, if I should do the traditional, which is probably a question for a lot of you guys. And if that is, write it down. And remember what I told you. So for those of you kind of jumped on late, write down all your questions. At the very end of this, you're going to be able to put all those down on paper and you'll get every question answered. So if this is one of those, write it down. So this federal employee came to us and they said, hey, I make $70,000 a year. Should I be in the Roth? And we said, well, let's look at the numbers and work them backwards. Now, again, these numbers changed this year with the new tax table. So these are actually pretty different from last year. So this federal employee is making $70,000 a year. The IRS standard deduction for a single filer this year is up to $16,100. Okay, that's a pretty sizable jump from last year. So that puts him at a taxable income, an adjusted gross income, at $53,900. Now, if we look at the tax brackets as a single filer, they are still, right, they were in the 22% tax bracket because they're making 70 grand, and the 22% tax bracket goes from 50,000 to 105, so they were in there. And even with the standard deduction, they are still in there because in order for them to go from the 22 down to the 12, this person would have to be below 50,401, as you can see on your screen. Okay, but this federal employee was contributing $10,000 to their traditional TSP. And because they were contributing to their traditional, that $10,000 also lowered their tax liabilities while they were working by that 10 grand. So what happened was when they were to go and fill out their tax return next year, with all these deductions and contributions, their total adjusted gross income was $43,900. That was their taxable income. Now what happened to their tax bracket? Well, because they contributed all of that money to TSP and the standard deduction brought them down, they brought them down to $43,900, which is about, give or take, $7,000, a little less than $7,000 below the limit before they go back to the 22, right? So you can see on your screen there, the 12% tax bracket for a single filer was $12,401 to $50,400. So just by using the TSP traditional, they lowered their tax liabilities from a 22 down to a 12. But what do you see here that's happening? This is a federal employee that had the opportunity to take advantage and get the best of all worlds. Why? Because from 43,900, this federal employee has all the way to 50,000. So like I said, just shy of that 7,000 mark to be able to put into, about 6,500, right? To be able to put into a Roth and still stay in the same 12% tax bracket. So this is the opportunity to use traditional to lower your tax liabilities and be in the Roth to get the best of all worlds on the tax advantages. Some of you go straight into the Roth, and if you did that, you would be in the 22% tax bracket. You didn't get the opportunity to lower your liabilities. So I'm bringing this to your attention because I see a lot of mistakes made. People hear Roth is the greatest thing since sliced bread, which I do believe it is. I think it's a great thing. But if you're able to take advantage of the best of all worlds, make sure you do so. I told you when I started this call that we are in I hate to use the word exciting, but we're in one of the most exciting tax times of our lifetime. I don't know if we're ever going to see taxes as low as they are right now. The brackets are as wide as they've ever been, with the marginal rates as low as they've ever been, right? This is the time more than ever. If 2026 is going to be a different year for you, and you say, I'm going to take advantage of everything I can this year and maximize it, this is your starting point. Okay, know the options, and again, this is what we can help with. So like, once again, if you have a question on this, or if you say, hey, I would like to get my Roth TSP numbers ran, write it down, and at the end of this workshop, you can put it down on the form that pops up, and we will run these numbers for you, just so you know what your options are. Okay, now the TSP catch-up, there is, obviously we talked about that, it's up to $8,000. New from 2025, I told you between ages 60 and 63, you had the ability to put 11,250. Now, here's something new for 26. I would write this down. If you earn more than 150,000 in 2025, your catch-up contributions must be Roth. Okay, your catch-up contributions are going to go into the Roth account because you make too much money. Word of caution. When you do this, I don't care if you're doing the catch-up, the special catch-up, whatever you're doing, make sure everything is done on a 26-pay period basis. We're at the beginning of the year, calculate it all out. I'll give you an example of what happened. I was teaching this workshop at one of the VA hospitals in Virginia, and I was on the site at their hospital, and at the end of the workshop, a doctor came up to me. He said, Ryan, this was September. He said, Ryan, I'm not getting matching contributions in my TSP. I said, well, that's odd. Why don't we take a look at what's going on? I looked at his leave and earnings statement, and he had meet the maximums for all contributions in September. And because he met those maximums, he didn't have the ability to get matching contributions because it's on a 26-pay period basis. He was missing out on them. So my plea to you is make sure everything you do, you calculate on a 26-pay period basis so that you get the maximum for everything as you're entitled to, okay? Now, you all got an email. Oh, let me back up here, sorry. You all got an email about this new Roth conversion piece. In 2026, you can do a Roth conversion inside TSP. Let me explain what a Roth conversion is before you jump in and do it, please, so that this is important. A Roth conversion is when you take your traditional TSP and you move it from traditional to Roth. Now that may sound easy, but there's an incredible amount of stuff that has to go into that decision. Tax planning at its highest level, okay? I'll give you an example. If you have $500,000 and you say, man, I get to make that tax-free now. Well, what's gonna happen is when you make that transaction, every single penny that gets transacted over there just became a taxable event for you. So if you move $100,000, and I'm going to make up a number here, so bear with me. If you move $100,000 and your tax bracket's a 22% tax bracket, you owe $22,000 in taxes. Okay, so I just want to make sure you understand that that 100,000 that you converted in this example is going to go on your tax return as a taxable income. So you better be prepared for that. Now, I'm going to give you some of the ins and outs of TSP's version of Roth conversion. Now, here I just said their version. TSP plays by their own rules in a lot of different ways, some good, some bad. Okay, I'm not saying this one is good or bad. I just need you to understand what the rules are here, because a lot of you already emailed us in asking questions about this. So I want to make sure I hit this hard. And again, if you still have more, ask after. So here's what happens. In that example that I gave you, if you take $100,000 and you convert it over to the Roth TSP, and you owe $22,000, inside the TSP, which is different from the private sector, you have to pay the taxes out of pocket. Okay, let me explain this. This is important. If you are in the private sector, take TSP out of the example for a second. Okay, let's say that you had $500,000 in an outside traditional IRA, and you want to go down, you want to do Roth conversions, and you say, well, same example, I'm going to take 100,000, I'm going to move it over to a Roth IRA. Okay, in the private world, you can withhold the tax from that transaction. That means that that $22,000 is going to come out of your 401k or IRA, and it's going to go automatically, because you told it to the IRS. And then, the remaining, what, $78,000 is what's going to get moved over to your Roth IRA. Okay, so that's in the private sector. You can withhold the tax on there and pay the tax out of your IRA. That is not the same of what Roth TSP conversions are. This is so important for a lot of you, because I've already seen people that have said, I'm doing a Roth conversion, not understanding that you cannot withhold taxes on the Roth conversion inside TSP. So if you are going to do a Roth conversion inside, I hope you have tens of thousands of dollars extra that you don't mind sending to the IRS, because if not, okay, this is going to really come back to bite you if you do not understand that rule. So let me say it one more time. A Roth conversion inside TSP, you cannot withhold the tax on that conversion. You have to pay the tax out of pocket. In the private sector, that does not work that way. If you have a traditional IRA and you're doing Roth conversions in a traditional IRA to a Roth IRA, you can withhold the money so you don't have to pay it out of pocket, okay? Not saying it's good or bad. Some of you have absolutely no problem paying the tax out of pocket. Most of you probably will never want to do that. But before you go and do a conversion, I need you to understand that is such an important variable here, okay? Now, if you are at the age of required minimum distribution, RMDs, which is when you hit age 73 or 75, the IRS forces you to take money. That RMD has to be taken first before completing a Roth conversion. And I know this is probably confusing, okay? And I apologize. These are rules that TSP has come up with. This is very different than what's on the outside, okay? So just understand, this is not private sector rules, this is TSP's rules. I know a lot of you are gonna have a lot of questions on this, so at the end, fill out the form and just say, hey, please help me out with some of these Roth conversions. We will be more than happy to explain this and kind of go through it. Now, you can complete a conversion every pay period. I don't see, most people won't do that. They'll do it in one big lump sum or maybe a couple times a year. But here's the other thing. If you have an outside Roth IRA, you cannot combine it with a Roth TSP account. Okay, can't combine it. On the flip side of that, if you have a Roth 401k or 403b from a previous employer, you can. So again, different rules. I know it's confused, different IRAs, different all this stuff. There's a lot to this, but what's important is understanding how this could really hurt you in the tax world if you're not paying attention, doing it properly. So before you make any of these decisions, if you are working with an advisor, please make sure they understand tax planning, because this is where a lot of mistakes get made. If you're working with an advisor that doesn't understand tax planning, go to your CPA. They can help you with that, because this is just too many opportunities for errors here. Okay. And again, I'm not trying to scare anybody. I'm just being straight with you to let you know what it is and what it isn't. And whatever decision you make has to be right for you and your family. Okay. So just an FYI. Now, this is what I was talking about on the outside. Okay. So let's say we took that TSP out of the equation and we're going to do a Roth conversion in the private sector. Okay. Well, that can be done. And again, but the thing is whenever you're doing a Roth conversion, whenever you open up a Roth IRA, if you don't already have one open, you start the new 5-year rule over. That's what TSP, and it's also in the private sector. Okay, so you'll have a 5-year rule. That means that in the first 5 years, whatever money goes into a Roth IRA, you can take the principal, which you put in, but if you touch the interest and the gains, you will create a tax liability for yourself. Okay, now after 5 years, everything is fully tax-free. That's a big misconception. Most people don't even know you can touch the principal. You can, but you just cannot touch the gains and interest until after that 5-year. And again, all the things I'm talking about, some of these they do require deep level of tax planning. We did over 100 Roth conversions with our clients this year, and it's not simple. You know, it does require quite a bit of understanding, and I'll give you kind of an example of what some things look like as we go. But here's the other thing that we talked about, kind of going beyond TSP, and remember how all these things have to work in harmony with each other, is Social Security. That changed a little bit this year too. And what happens is every year, the earnings that you can get a credit for, they go up. And so what happens is in 2026, every time you earn $1,890, you get a credit. Now, with Social Security, you can get up to 4 credits per year. And in order for you to be eligible for Social Security, you have to have, really 40 credits, which is 10 full years of working. Because to earn 4 credits, you make $7,560, and you get that. Now, what's important for a lot of you to know, and I'm gonna give you some just kind of insider things to pay attention to. Your Social Security is based on your highest 35 years of earnings. Now, I'm telling you this because, again, I want you to maximize the income from your Social Security as much as I want you to in TSP and all these other things. So if we know that it's based on your highest 35 years of earnings, I want you to do something. I write this down. Go to SSA.gov, Social Security Administration.gov. So go to SSA.gov, and I want you to go and I want you to print your most recent statement. Why do I want you to do that? Because there are 3 really important pages. The first page is going to tell you basically, your age and what you're entitled to. The second page is going to talk about your different ages and what your Social Security benefits are going to be at those ages. The third page is actually the most important page. It's the most overlooked page. The third page is going to give you a breakdown of your entire life's earnings history. Now, this is really important because we have had a lot of clients that have attended these workshops that we're doing here and said, hey, all right, I went and got it, now what? And we're reviewing that Social Security statement with them. And what we find is there are years, some of their biggest earning years, that have a 0 next to it, which means that income wasn't recorded that year. And a lot of mistakes happen. And so again, I want you to pay attention to that and make sure there are no zeroed out years, because if there are, you're going to have to go back and make sure Social Security knows that they need to fill that in. We were doing a workshop for NASA, actually, and we had a NASA employee come up to us after, and we were going through their Social Security statement, and that employee from 2017 to 2020 to 2020, they had zeros, and that was their biggest earning years. Social Security made a mistake. They had to go back and prove their income with their tax returns. It's not fun, but it's something that everybody should be paying attention to, okay? Because this is a big part of your retirement, and these change all the time. So there's this thing called an earnings test. Now, this is important because these numbers change as well. Why this is important to a lot of you is some of you may be retiring this year or within the next 2 years, and you're going to start your Social Security, but on top of your Social Security, maybe you go out and get a part-time job because you want to stay busy. I need you to understand that until you reach your full retirement age, for most of you it's 66 to 67, okay, for Social Security, there are limits to how much you can make before you start getting penalized. Let me give you an example. These numbers changed in 2026, okay? So if you are 62, but from age 62 to the year you are going to turn 67, there are limits to how much you can make before you're penalized. So here's the example. If you're retired and you turn on your Social Security at 62 and you go out and you work a part-time job or you work a full-time job and you make more than $24,480, your Social Security could be cut in half. It's reduced $1 for every 2 that you make. Okay, that's really important because if you are getting ready to retire and the decision of I'm going to turn on my Social Security because I want to versus I need to, maybe this plays a little bit of a factor, because if you go, well, I'm going to turn my Social Security on because I want to, I don't really need it, but knowing that if you do turn it on, you're going to have half it cut in half anyways, maybe that's a decision you hold off on. Okay, and again, I don't know your situation, but just think about these things from a strategy perspective. I'll give you an example. We had a federal employee that took the early retirement last year, and this was something he was battling. He was going, do I do this, do I not? And when we looked at it, he was going to be taking a consulting job, and he was going to make so much money that having his Social Security cut in half didn't make any sense, right? So those are the things you really pay attention to. Now, what changes is the year that you turn your full retirement age. So let's say this year you're going to be 67, and it's January 29th, and you turn 67 on July 1st. Well, you can go out and you can make $65,160, and if you make more than that, your Social Security would be reduced by a third. Okay, so not as bad of a penalty, but still there. And these numbers did change. They went up this year, which gives you a little bit more flexibility, which was good. Last year it was around 23,000. This year it's 24, so a little bit extra. But let me tell you what's not included in here. So your pension from the government is not counted towards the earnings test. Your Social Security is not counted towards the earnings test. Your TSP or IRA distributions are not counted towards the earnings test, okay? This is only W-2 or 1099 income earned as a wage. Okay, so that's important to know. You can go out and, you can have all those 3 income sources and go out and make an extra 20 grand part-time and still not have anything affected. Now, where that also changes is on how Social Security is taxed. Now, I want you to go back to my 3 buckets that I broke down, right? We said everything has to work in harmony with each other, because if they don't, your pension and your TSP distribution could affect how your Social Security is taxed, okay? This is the example of how that happens. So if you are a single filer, all right, and you make below 25,000, none of your Social Security is taxable income. If you make between 25,000 and 34,000, up to 50% of your Social Security could be a taxable income on your tax return. Now, if you make over 34,000 as a single filer, up to 85% of your Social Security could be a taxable income on your tax return. Let me give you an example of what that means, because people are going, man, 85. What that means is you're not going to lose 85% of your Social Security. What it means is that if you are making $1,000 a month and you're above the $34,000, again, $1,000 a month in Social Security benefits, that means that $850 out of your $1,000 per month is going to go on your tax return as a taxable income. So if you're making $12,000 a year, that's about $10,500 that's going to go on your tax return as a taxable income. But the amount of money you make from your pension goes towards this Social Security taxation. The amount of money that comes out of your traditional TSP or traditional IRAs goes towards this Social Security taxation. Half of your Social Security benefit gets added into the equation. And when you add all that up, what are you left with, right? You may be in a 50% taxable, but maybe you take a little bit too much from TSP because you just want the extra, which is fine, and that bumps you to an 85. You got to understand, you got to pay attention to that because that really does affect your taxes. And if you don't withhold, you can end up owing a lot of money, okay? Because this is based on your federal tax bracket. Now, for those of you that are married filing jointly, if the two of your incomes combined are less than $32,000, then there's no tax for either one of you. If the two of you combined make between $32,000 and $44,000, up to 50% of your money could be taxable. Now, if you make above $44,000, up to 85% of both of your Social Securities are now a taxable income. Some of you are probably going, but Ryan, didn't Congress try to make a bill or try to pass a bill where Social Security will not be taxable anymore? They tried, it didn't work. But what they did give you for a certain period of time, if you were 65, you get an additional $6,000 tax credit, but there are things you have to meet. If you make too much money, you won't even be eligible for that tax credit. So you have to understand the rules there. It sounded great in theory, but a lot of people will either phase out of it, only get a portion of it, or get none of it based on their incomes. So it may or may not even help you in this situation, okay? That's why you have to plan for this right here. Now, here's an example. There's great software out there. This is the software that we use when we do this kind of tax planning. We think about things like Roth Conversions. This was a client. Now, forgive me, this is an extreme client. This is one of our clients that had $2 million, but I wanted you to kind of get an example of, this is a client that came to us and they're age 65 and they said, hey, I want to do these Roth Conversions. What you want to know is exactly how much you can convert and what the tax liability is going to be on that. Okay, so here's an example. These couple right here, they could do a Roth conversion, and this is extreme, of $108,000 and $108,058 to the dollar. Okay, this is what you want to know as you begin doing tax planning and how much you can convert and what's going to be taxable from there and so on and so forth. Okay, so that's important for everybody to know. And again, I'm not going to spend too much time on this, but I want you just to see there are tools that you can use to make these determinations and these planning. Okay, again, this client right here, this just kind of shows you some fancy bar graphs, but it shows you that they paid $37,000 less in taxes by doing Roth conversions. I don't know about you. I don't know if you like saving money in taxes, but doing Roth conversions could be a phenomenal way for you to save a lot of money, mainly because one of the biggest killers of people's retirement is the required minimum distribution. And that's when, again, the IRS forces you to take money. RMDs are based on and calculated based on the traditional amount of money you have. And so the money you have in traditional TSP, traditional IRAs, the IRS adds all that up and they tell you based on that how much you have to take out. Now, again, you're responsible for setting this up. And if you don't take RMDs, it's up to a 25% tax penalty for that. So here's an example. RMDs could affect and put you to a higher tax bracket. They could affect your Social Security, because what if you were taking $10,000 a year out of your TSP and life was pretty good, but the IRS makes you take out 20%? And you didn't need that additional $10,000, but what if that additional $10,000 was the thing that bumped your Social Security to now become taxable? Wouldn't you want to know that now instead of finding that out at 75? Because now you can be proactive versus being reactive, and that's a really important place to be in, is being proactive versus reactive, right? So again, there's a lot of different things that you can do, a lot of strategies. I'm just giving you a couple ideas here. This is a real breakdown for those of you tax planning, okay? So if you had $500,000 in your TSP and you were of age to where the IRS is going to force you to take those required minimum distributions out, they would force you to take out $20,325.20. Once again, what if you only needed 10,000 of it? Well, too bad, right? They're going to force you. If you do those Roth conversions, it is a phenomenal way for you to lower your tax liabilities, because instead of this 500,000 in the traditional, where they force you to take money, you can have $500,000 in Roth and not be forced to take a penny that you don't need. Okay, very big difference between the two. Now, let's just put it all together. I know it's a lot of information, it's a lot of changes, but I wanted you to see this, so you got your Social Security, pension, TSP, they all have to work in harmony together. So here's a couple steps. Understand where you are right now. Know your numbers, your expenses, your debts. Do you know what your pension is going to be? We can run projections for you, no problem. Your Social Security benefits, how to maximize that. By the way, if you're married, there are 81 different ways for a married couple to file for Social Security, 81 different combinations. Do you know the best one? All these different things. Develop a successful plan. And listen, execute on the plan. We see so many people that have a really good strategy built out for them and never take action on it. Just take action on it. Take advantage of what's given to you, okay? So have a game plan, put it all together, get help if you need it. Now, last thing I'm going to tell you is this is a copy of what a benefit analysis looks like. It's going to show you what your pension projection is going to be, your Social Security projection, and also your TSP projection. And you will get that if you want it, just ask for it. But here's again what I ask you to do. A lot of you have probably a lot of questions coming out of this workshop. Write your questions down. There's going to be an ability for you in about 1 minute to have a pop-up that's going to come up and ask you what questions you have. Write us a book. Honestly, we have people that write paragraphs and paragraphs of questions. It allows us to know how to help you better. So don't be afraid to put as much information as you can when that pops up. We will call you and get your answers to you, okay? Your personal answers will be going over, and so you know how to best maximize everything. So with that, I want to say thank you so much. If you need anything, we're here to help. You can reach out to us at info@myfed University or give us a call. If not, we look forward to work with you in the future. Thanks so much for attending. Take care, everybody.